All right, let's talk about May 15th. On this one day, one of the most powerful economic jobs in the entire world is about to change hands. But here's the thing. The person walking into that role, they're not inheriting some glorious prize. No, they're walking straight into a trap.
Yeah, you heard that right. May 15th is the day Jerome Powell's term as the chair of the Federal Reserve officially comes to an end. President Trump has picked his replacement, Kevin Warsh, who's now just waiting on that Senate confirmation. But man, the timing couldn't be tougher. He's about to step into what might be one of the trickiest economic spots we've seen in a long, long time.
And that right there, that's the trap. See, the new chair is immediately stuck in what we're calling the interest rate puzzle. Just picture it. On one hand, you've got all these inflationary pressures building up. You know, the war in Iran, new tariffs, they're all pushing prices up. But on the other hand, there's this huge, intense pressure from politicians in the market to do the exact opposite, to lower interest rates.
So what on earth do you do? I mean, what happens when you cut rates at the exact same time that inflation is heating up? That is the puzzle. And don't worry, by the time we're done here, I'm gonna walk you through 3 different scenarios for how this whole thing could play out.
Okay, before we get into the scenarios, we need to get one thing straight, because it's super important to understanding the stakes here. It's this: all money is connected. And the one single number that has the most power, the most power over your entire portfolio, it's the one right at the center of this mess, the interest rate. The easiest way to think about the interest rate is just the price of money. That's it. And when that price tag changes, well, everything moves. It's like a domino effect. We're talking about your mortgage, your credit card bills, how much it costs for big companies to borrow, even stock prices and bond values. One little number change, and all those things shift, all at once.
So where are we right now? Well, that price, the U.S. federal funds rate, is sitting in the range of 3.5% to 3.75%. Now, what's interesting is the Fed actually cut rates 3 times last year, but then come January, they kind of slammed on the brakes. They decided to just hold steady. And that decision, that pause, it's absolutely crucial to what happens next.
And right at that moment, just as the Fed hits pause, the global economy gets walloped by 3 major inflationary pressures, all hitting at pretty much the exact same time.
Okay, so what were they? First, the conflict in Iran. Boom, oil prices shoot past $80 a barrel. Second, new tariffs kick in, making everything we import more expensive. And third, you've got this insane investment boom in AI infrastructure, which is just sucking up a ton of energy. So you have 3 totally separate things, but they're all pushing in the same direction, creating this constant, nagging inflationary pressure. And that pressure is basically putting the Fed in a straitjacket.
So, here's where it gets really fascinating. This May 15th thing, it's not just about swapping one person for another. We could be looking at a fundamental shift in the entire philosophy of the U.S. central bank.
Think about it. Chairman Powell's whole approach is to be patient, to be driven by the data, right? He waits to see what the numbers are telling him before he makes a move. Kevin Warsh, he's not that guy. He's not talking about waiting. He's on the record calling for a full-on regime change at the Fed.
And this regime change he talks about really comes down to 3 big ideas. First, he's a big believer that AI is a game changer for productivity. He thinks the economy can actually grow way faster than we expect without causing inflation, which, if he's right, means you can cut rates. Second, he looks at the Fed's balance sheet, all the assets it holds, and says it's way too bloated and needs to be shrunk down. He calls this his sound money principle. It's basically about the Fed cleaning up its own books. And third, he thinks the Fed should get back to basics. Stop worrying about things like climate change and focus only on its core job, keeping prices stable and people employed.
But it's never that simple, is it? Even if he gets the job, trying to put this new philosophy into action is, well, it's not going to be a walk in the park. There are a couple of major political traps lurking here.
So trap number 1 is an internal one. Yeah, the Fed chair is a big deal, but they don't have a magic wand to set interest rates. Every single decision goes to a vote. There's a 12-member committee, the FOMC, and you need a majority to get anything done. So it doesn't matter how badly the new chair wants to cut rates, he's got to get other people on board. And the second trap? It's pure politics. Wardish's confirmation isn't even a done deal yet. You've got Senator Thom Tillis threatening to block Fed nominations because of a totally separate issue. This just throws a huge cloud of uncertainty over the Fed's leadership at the exact moment when, let's be honest, the economy really needs a clear signal. All right, so we've laid out all the pieces of the puzzle. Now, let's actually try to solve it. I'm going to walk you through 3 possible scenarios for how this all shakes out.
First up, let's look at scenario 1. We'll call this the pause. So imagine this.
The conflict in Iran keeps going, and inflation starts creeping back up over 3%. The new chair might want to cut rates, but the rest of the committee looks at that inflation number and gets nervous. They just won't vote for it.
And the result of that disagreement? Gridlock. Rates stay frozen exactly where they are for the rest of the year. And look, this isn't some wild fantasy. JP Morgan, the big bank, has already changed their forecast. They're now predicting 0 rate cuts this year because they see this exact scenario as a real possibility.
So, what does this pause world look like for your portfolio? Well, the stuff that tends to do well are things that benefit from high, steady rates. So think about short-term treasuries, money market funds, maybe some high dividend stocks. But on the flip side, those high-flying NASDAQ growth stocks, the real estate market, and any company with a ton of debt, they could be in for a rough ride.
Okay, now let's talk about a much tougher scenario. Scenario 2, the squeeze. This is the one nobody wants to see. It's when you get rising inflation and a slowing economy hitting at the same time. You've probably heard the ugly name for it, stagflation.
In this world, those high oil prices and tariffs really start to bite. People stop spending as much, businesses get nervous and stop investing, and this puts the Fed in a truly impossible position. I mean, they're caught between a rock and a hard place. If they raise rates to fight inflation, they could totally tank the economy. But if they cut rates to try and help the economy, inflation could just take off like a rocket.
And this is the key thing to get about stagflation. It's just brutal for almost every kind of investment. There are very few places to hide. Maybe energy stocks, companies that sell consumer staples, things people have to buy no matter what, and maybe some inflation-linked bonds. But for the most part, growth stocks, real estate, regular bonds, tech, pretty much everything else will be getting hammered.
All right, that brings us to our third and final possibility. Let's call this one the new chair scenario. This is the world where Kevin Warsh gets confirmed, and he actually manages to push his new agenda through.
In this version of the future, his big argument that AI is boosting productivity so much that we can cut rates actually wins over the committee. So the Fed starts to cut interest rates, and at the same time they start to shrink their massive balance sheet, putting that whole sound money idea into practice. And this just shows you how a big policy change creates a totally different set of winners and losers. In this world, things like AI infrastructure, semiconductor companies, and real estate would probably do really well. But remember those assets that were winners in our pause scenario, like money market funds? Now, they'd be struggling. And with lower interest rates, the US dollar would probably start to weaken too.
So after all that, what's the big takeaway? Look, the point here isn't to try and be a fortune teller and predict exactly which scenario is going to happen. The real key is to just understand that all 3 of these are very real possibilities. The conditions are there for any one of them to play out, and the smart move is to think about what each one means and how you might prepare for it.
So there you have it, the pause, the squeeze, or the new chair. 3 totally different paths, right? And each one means something very, very different for your portfolio. The stage is set, all the pieces are moving. So the big question is, which path will the new Fed actually choose?